Hello, and welcome to Session 10 of the Basic Tax course. We're going to begin Session 10 with a review of the Session 8 quiz answer key. And let's begin with the first most frequently missed question, which was question number 11. You must fly your dependent child to San Francisco for special treatment not available in your home city. What medical expenses can you deduct? And we provide 4 options. So let's just summarize what you can deduct, which I take from memory. You can deduct up to $50 per night per person who must travel with a person who needs medical care. You may also deduct the cost of the actual medical care, but you're not allowed to deduct the cost of meals, and you're not allowed to deduct the cost of lodging that exceeds $50 per night per person. So when we narrow it down to those simple rules, it shouldn't be that hard to see which one is the correct answer, and I have highlighted that in green for you. Item A says the cost of the child's hospital and medical bills, the cost of travel, and up to $50 per person per night for lodging. So that's what's allowed. But the cost of hospital, medical bills, and the cost of travel up to $100 per night? No, $100 per night is too high. It's $50 per person per night. The cost of the child's hospital and medical bills? Yes. The cost of travel? Yes. The cost of lodging up to $50 per night? Yes. But there's a big no on the meals. Meals are not allowed, and when we go to D, not only do we still have meals, but we're up to $100 a night again. So for 11, the correct answer is A. The next problem we're going to discuss is the mini problem, and it involves a character named Daisy May, age 63, who had the following expenses for the year. And it was your job to sort through these expenses and decide what was deductible and what was not. There was only one key number that we threw at you that was non-deductible, and I've highlighted that in red. It's pre-tax medical insurance premiums. Clearly, if you've already had your salary reduced and you're not paying tax on the money used to pay for medical, you can't turn around and claim a second deduction for it. So the first item in line is not deductible. We then list prescription copays, reading glasses, dental visits, and even orthopedic shoes are just fine. We also gave you medical miles, and you had to do a little bit more of a computation down here to figure the medical miles. It's 19 cents a mile for the first half of the year and 23.5 cents a mile for the second half of the year. When you multiply that out, you end up with a total deduction for medical mileage of $53. So if we add up these 4 expenses plus the medical miles, we go over to the Schedule A and enter that total. It's $1,053. But we did give you Daisy's AGI, and Daisy's AGI is simply too high. If you multiply $56,000 by 7.5%, you get $4,200. $4,200 is more than her expenses. Her deduction is therefore 0. Moving on to the next item in line, we are looking at deductible taxes, and the first in the list are the state estimated tax payments. All of these estimated tax payments were paid in the year 2011, and therefore they are deductible for 2011. If you add them up, you get $1,900, and we carry that over to line 5 and check box A. Next in line, we have real estate taxes, and Daisy paid real estate taxes on 2 separate properties. One is her primary home and one is her vacation home. They're both allowable. We take the total, which is $3,645, and enter those on line 6. Next in line is the personal property tax that she paid on a trailer, and that is deductible. It is deductible on line 7 of Schedule A, so we carried that $461 over to line 7. The final item in line is $265 in foreign tax. We enter that on line 8 and type a description in foreign income tax. We therefore have total deductions on line 9 for Daisy of $6,271, and we scroll to the bottom of the form. That is her total itemized deductions for the year. So that concludes the review of the Session 8 quiz. It is now time to move on to the Session 9 homework assignment. And Session 10 password number 1 is Seagull. S-E-A-G-U-L-L. And here we have the Session 9 homework assignment up on the screen in front of you. And let's just take a look at what makes this assignment up and make some decisions about what's deductible, what's not, where it's going to go on the form, the Schedule A form that is. And then we'll take a look at the answer key together. So firstly, let's just analyze or break this problem down into component parts, because by doing that, you're going to make more sense of it. Dr. Hewer is single. Okay, we're going to put single as his filing status. He works as a doctor. We know his profession. He wants to contribute $3 to the presidential election campaign fund. We will check the yes box. Dr. Hewer bought his first home on a contract sale from Wilma Deering. Well, the fact that he has a contract sale means he does not have a 1098 mortgage statement, so he will need to enter the mortgage interest he paid on a separate line on Schedule A rather than on the 1098 line. So we have to enter her name, her address, her social security number right on Schedule A. We know that right now by looking at it. Also, we can see that he took out a home equity loan to buy a new boat, and he also took out a home improvement loan that is secured by his home during the year. Well, home equity loan interest can be deductible, and the home improvement interest can also be deductible. Dr. Hewer has no idea what he can deduct and hopes that you can help him. Now we can see that he has some income here. He has interest income of $300 and dividend income of $300. Both of those are investment income, and they total $600. So let's just keep that $600 figure in our minds for just a moment. Then moving on down to the next page, we can see what some of the items are that are listed. The first item in line is health insurance premiums that are shown on a W-2. Well, we know that health insurance premiums showing on a W-2 are going to be a salary deferral benefit or a non-taxable fringe benefit, so clearly those cannot be deducted a second time. So I'm going to highlight in red that that is a no. Moving on to the next items in the list, we have unreimbursed medical bills and prescription drugs. Both of those are allowable. So we will highlight those allowable deductions in green. Sales tax paid on a new boat that is the same as the general sales tax rate. That is a deductible expense. We do need to be concerned about whether or not he has any deductible expenses for income tax as well, because he's not going to be able to deduct both sales tax and income tax on the same tax return. And if we look at his W-2, we see that he has zero income tax withholding because he is a resident of the state of Washington. So that kind of makes it an easy decision. Since he's not paying income tax, he lives in a state that does not have income tax, we know that the sales tax option is going to be the best one for him. Next in line, we have 1098 home equity interest. That will go on a different line than the home mortgage interest paid to Wilma Deering, but both of those types of interest are deductible. And the loan origination fee that was used for home improvements on the equity loan closing, that is also deductible. That is going to be deductible as points paid. And if the points appear on a 1098, they go on the same line as 1098. If they do not appear on a 1098, they go on a separate line. Then we have property taxes, mortgage interest not reported on a 1098, and qualified mortgage insurance premiums. All of those are deductible and have to go on select lines of the Schedule A. So we'll say yes, those are deductible. And then we have cash to Salvation Army, for which Dr. Hewer has a receipt, and furniture to Goodwill, for which he has receipts. And you can see that the donation of non-cash or in-kind items to Goodwill is less than $500. He does not need to do the additional Form 8283. He can just report that expense or that contribution directly on his Schedule A. Dr. Hewer paid a $75 early withdrawal penalty. That is deductible as an adjustment to income. And go ahead and prepare his tax return. So let's go ahead and do that. Now I have the answer key for the Session 9 homework assignment on the screen in front of you, and much of what I've already pointed out to you is covered in the opening paragraphs of this. We, of course, have to look at Dr. Hewer's adjusted gross income. His AGI is high enough that even though he does have $2,600 of qualifying medical expenses, that amount is less than his adjusted gross income, so he's not going to get to claim any kind of medical deduction this year. On the Schedule A, line 5 is where we claim a deduction for taxes paid, and you can either claim the state sales tax deduction or the income tax deduction, and in Dr. Hewer's case, he's going for the state sales tax deduction. But we're going to have to do a worksheet to figure out the amount of that deduction. The Washington state tax rate is 6.5%, and the King County rate is 2.1%. So we're going to use the sales tax deduction worksheet to figure the amount of his deduction. And while we're doing that, we need to add in the sales tax that he paid on that new boat. So if we go over here to the problem itself, the sales tax paid on the new boat was $3,200. These are the rates in King County and in Washington state, and his income is $55,000 plus the investment income that he had for the year. So let's move down to that sales tax worksheet, which is in the answer key here. We can see it on page 2 of the answer key, we start by going to the optional state sales tax table for Washington State. If you look up the tax based on Dr. Hewer's income, we have $686 as the amount shown on those tables. The next step is to enter the local rate and the state rate, and you divide the local rate by the state rate, and you can see that it's a pretty high ratio. We get 32% of the local rate is 32% of the state rate, and so ultimately 32% of $686 is $222. And so Dr. Hewer will get $686, plus he will get $222, plus he will get that sales tax he paid on the purchase of his new boat. His total state sales tax deduction is going to be $4,108. Here is Dr. Hewer's 1040 return. We can see that he has $55,000 of wage income, $300 of interest income, $300 of dividend income, giving him $55,600 of total income. He claims an early withdrawal penalty as an adjustment to income. Therefore, his adjusted gross income is $55,525. Moving on to the next page of the form, we can see on line 40 that we need to enter his itemized deductions. So let's finish his Schedule A and see where we came up with our number. Here is his Schedule A, and again you can see we've entered his medical expenses and the 7.5% limit, giving him a deduction of 0. We've entered the deduction for sales tax paid on line 5 and checked box B. Next in line we have real estate taxes paid, and if we go back over to the wording of the problem, we can see that the property taxes that he paid on his home were $1,200. So we're going to enter $1,200 on line 6. Line 9 totals those two different deductions up, and we get $5,308 of total tax being deductible for Dr. Hewer for 2011. Then in line 10, we've entered the mortgage interest and points that were reported on a 1098. We move over and we see that the 1098 home equity interest is $500, but the loan origination fee, we didn't actually tell you that that was on the 1098, so we've elected to enter that on points not reported to you on a Form 1098. We've entered that on line 12. So the 1098 mortgage interest is on line 10. The points paid on the home improvement loan are $250, not reported on a 1098. So we've put those on line 12. Then on line 11, we need to enter the information relating to Wilma Deering. Dr. Hewer paid her $6,500 of mortgage interest for the year. We've entered her name, her Social Security number, and her address as required. The final line is where we enter the mortgage insurance premiums deduction, and the mortgage insurance premiums are fully deductible. Dr. Hewer is not subject to a phase-out based on his income. You can see we said that was $1,188. That is the amount that we entered. Finally, we have a small amount of charity for the year, $180 of cash, $375 of non-cash, totaling $555. And that leaves Dr. Hewer with a total of $14,301 of itemized deductions for the year. Going back up to page 2 of Form 1040, we've entered that total, $14,301 on line 40. We figure his exemption deduction at $3,700. His taxable income is $37,524. His tax is $5,506. He had $5,000 withheld, so he owes $506. That concludes the review of the Session 9 homework answer key. At this point, please push pause on video playback and complete the Session 9 quiz. When you are ready, resume playback for the Session 10 lecture. And now we're going to move on to a discussion of miscellaneous itemized deductions. The IRS allows deductions for certain items, but they're typically related to income production. So when we think about miscellaneous itemized deductions, is this a deduction I am allowed to claim on my Schedule A? The intuitive answer is, well, is the deduction associated with income in any way? Because if it's not associated with income, then it's probably not going to be deductible. It's not a total 100% true rule, but most of the time that's what we're looking at. Do I have income that I've reported on my tax return now or at an earlier time that's creating a cost to me in this expense that it ties to my income in some way? So just looking intuitively at a deduction when a client asks you, can I deduct this? The first thing going through the mind is, well, how is it tied to income production? If it's not tied to income production, then probably not, but maybe. So let's research it a little bit further. So the IRS says that the itemized deductions that you are allowed to claim for miscellaneous items include things like unreimbursed employee business expenses for car, travel, meals, entertainment, and education. Also job search expenses. Job search expenses are tied to income. When you get a job, you're going to work, and you're going to pay tax on the money you make. That's why they're allowing it. Union dues, they're deductible because you pay union dues to ensure that you get a good paying job, right? That's going to get taxed. Tax advice and preparation fees. Well, that's paying your taxes, so they allow that. Safe deposit box rental when the box contains investment property. So lots of people think, oh, I have a safe deposit box, I can deduct it. But you have to show that you have income-producing property in that box. Then you can deduct the cost of the box. Hobby losses to the extent of hobby income. So hobby losses in and of themselves are not deductible, but if you can show that you had hobby income, you're allowed to offset that income with the losses that occur. Gambling losses to the extent of gambling winnings. So if I go and gamble my money and lose it all, I'm not going to be able to claim a deduction for that. But if I win and I had some losses against those winnings, then those losses are allowed to the extent that I have winnings. There is, of course, a 2% limitation on most miscellaneous deductions, but not all. And how does the 2% limit work? Well, you take your adjusted gross income and multiply that out by 2%, and you get obviously 2% of your AGI. And so we have an example here. If your AGI is $40,000, you're going to multiply that by 2% and you get $800. So do your itemized deductions for miscellaneous employee business expenses amount to enough to matter? Well, they might matter to your pocketbook, but they're only going to matter on the tax return if they're more than 2% of your AGI. So if during the year you had employee business expenses of $600, but your income is $40, then clearly you will not have a deduction for the year. Because although substantial, $600 is less than 2% of your income, so it's not enough to be deductible. And quite frankly, for most of the clients I ever work with, they might spend a few $100s on business expenses during the year. But 2% of their AGI is usually a much higher number than the amount that they spend on employee expenses. But every once in a while, I do have a client who comes along and they spent enough. And then the question is, did what they spent money on qualify as a deduction? So we're going to be taking a look at that. Now, if you do have amounts that you paid for unreimbursed expenses as an employee, they could be deductible, and if they are, you put them on Schedule A. But you can only deduct unreimbursed employee expenses that are paid or incurred during your tax year, that are paid for carrying on your trade or business of being an employee, and are ordinary and necessary. The IRS says that an expense is ordinary if it is common and accepted in your trade or business or profession, or an expense must be necessary if it is appropriate and helpful to your business. So an expense is necessary if it's helpful to your business, and it's ordinary if it's common. And the IRS says it needs to be both of those things to be deductible. But IRS does also say that an expense does not have to be required to be considered necessary. And I have a very silly example that I've used for years. Every person in attendance today is probably sitting on a chair. But a chair really is not necessary for attendance. You could sit on the floor. So it's not indispensable. You could survive without the chair, but it's ordinary, in the business. It's a normal thing to have a chair, so it's going to be acceptable. So that's the type of thing that they're looking at. Is it something that is commonly used in a business? Is it considered necessary for the type of work you're doing? And it would be necessary because it helps facilitate the work, make it more efficient. Interestingly, one of the things I've never seen written in IRS rules anywhere is the cost of an item. Now, they do get with employee business expenses when you're traveling or claiming entertainment expenses about whether the expense is lavish or extravagant. But when we're looking at just the sheer expense of running a business or being an employee, if you buy a $600 laptop computer or a $5,000 laptop computer, they don't seem to put a restriction on that. That's not what they're really looking at. Just is it ordinary and necessary for your work? And maybe the $5,000 laptop is necessary. All right, so you may be able to deduct the following items as employee business expenses, and this is a list that comes right out of IRS publication 529. Now, if you want to know more details on any of these items, you would, of course, go to 529 and read those details. I've just taken kind of the bullet points out. If they trigger something in you that you say, hey, I want to know more, then go to the publication for that. But the items that are listed as qualifying, or the types of items that the IRS considers qualifying, include business bad debt of an employee, business liability insurance premiums, damages paid to a former employer for breach of an employment contract, depreciation on a computer that your employer requires you to use in your work, dues to a chamber of commerce if membership helps you do your job, dues to professional society, educator expenses, home office or part of your home used regularly and exclusively for your work, job search expenses in your present occupation, laboratory breakage fees, legal fees related to your work, license and regulatory fees, malpractice insurance premiums, medical examinations required by an employer, occupational taxes, passport for a business trip, repayment of an income aid payment received under an employer's plan, research expenses of a college professor, rural mail carrier's vehicle expenses, subscriptions to professional journals and trade magazines related to your work, tools and supplies used in your work, travel, transportation, meals, entertainment, gifts, and local lodging related to your work, union dues and expenses, work clothes and uniforms if they are required by your employer and not suitable for everyday use, and work-related education. So we're not going to look at all of those in detail, but we're going to look at some of the most important ones in greater detail. And the first one we're going to look at is travel expenses. Now, the IRS has an entire publication devoted to the most common types of employee business expenses, publication 463, travel, entertainment, gift, and car expenses. So most of what I'm going to be covering in this portion of our class comes from publication 463. And I actually read that publication cover to cover over the weekend. It was a pleasure. And you learn something when you read something. In fact, we had a factual error in our manual that I only knew to correct because I read the publication cover to cover. And it was a one-sentence paragraph in the middle of the publication about a law change that occurred in 2011. And the only way to know it would have been to have read it. So it doesn't hurt every once in a while to read one of those publications cover to cover. A, because you might learn something you didn't know, and B, because you might find out something changed and you didn't know about it. Either way, you're learning something important. Travel expenses is, of course, the first one we're looking at there. And to claim travel costs, you have to have something called a regular place of abode. And IRS says you have to have a regular place of abode in a real and substantial sense. And IRS says you have a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode and you use it while you're doing business. Your living expenses incurred at your claimed abode are duplicated when you are away on business, and you have not abandoned the vicinity in which your place of lodging and claimed abode are both located, or you have a family member or members, marital or lineal, currently residing at your claimed abode, or you use the claimed abode frequently. Now, I'm not going to go into a bunch of examples about or illustrations of when you have an abode and when you don't, but the IRS publication 463 has several. So if you have questions, a client is sitting across from you and you're trying to establish, does this person have a tax home in the, do they have an abode in the vicinity of their tax home? Do they have it or not? Go to the publication and read the illustrations that are in there. Now, the second part beyond having an abode is that you do have to have a tax home. Your tax home is your regular place of business or post of duty, regardless of where you maintain your family home. It includes the entire city or general area where your main place of business or work is located. You can claim the cost of expenses you incur while traveling away from your tax home overnight. If you do not have a regular place of business or post of duty and there is no place where you regularly live, you are considered to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. So here's what IRS is saying. You want to travel, and you want to claim business expenses for that travel. You've got to prove that you have a home. They call it an abode. And the abode has to be something, well, that you maintain and you live in, and that you pay money to keep. because you can't be duplicating travel expenses when you travel away from home if you're not paying for your home. So you have a place to live. You have costs associated with where you live. Now you're traveling away from home, and because you're traveling away from home, you're paying to live somewhere or sleep somewhere on top of what you're already paying at home. Now, clearly, if you have a house that's free and clear, you may not have as much expense as a person who has a mortgage, but there would still be expenses associated with maintaining an abode, even if you own it free and clear. The second test is that you actually have to have a tax home. And when you're traveling for business, you have to be traveling away from your tax home. So how do you establish whether or not you have a tax home? How do you establish where your tax home is? That's the next thing we're looking at. Well, to have a tax home, you have to have a main place of business or work. If you have more than one place of work, consider the following when determining which one is your main place of business or work. Firstly, look at the total time you ordinarily spend in each place and the level of your business activity in each place and whether your income from each place is significant or insignificant. So tax home, let's suppose that you have a city that you live in, and that is also where you work. So you get up in the morning, you get in your car, and you drive to work. That would clearly be your tax home. It's easily identifiable. You live there, you work there. But what if you live in a city and you have a job in that city, but you also have another job in another city? And part of the year you live in your home and you work in one city, and part of the year you leave your home and you go work in another city. Which one of those cities is your tax home? Is the city that you live in with your home your tax home, or is it the other city? Instinct says, well, the place I live is my tax home for sure. But IRS says, no, it's not that simple. You have to look at how much time you're spending in each city that you work in. And the city that you work in the most and earn the most money from is probably your tax home, even if that city is not the place that you have your main home. So to be claiming moving expenses, you have to have a home or abode that you're keeping up, that you're living in, but you also have to have a tax home. And usually, for most taxpayers out there, tax home and abode are the same thing. But sometimes there's a difference. And IRS, when they're auditing a taxpayer, the first thing they're trying to establish is where was your tax home and were you traveling away from it on business? So we're establishing whether or not we have a tax home, and we're establishing whether or not we have an abode. Now we're talking about, am I traveling away from my home? IRS says you are traveling away from home if your duties require you to be away from the general area of your tax home substantially longer than an ordinary day's work, and you need to sleep or rest to meet the demands of your work while away from home. Now, it's sleep or rest. Doesn't mean you have to sleep. Just that you're resting is enough. This rest requirement is not satisfied merely by napping in your car, however. You do not have to be away from your tax home for a whole day or from dawn to dusk, as long as your relief from duty is long enough for you to get necessary sleep or rest. And I did copy out a couple of examples that appear in Publication 463 for you. This is right from the IRS's mouth, so to speak. And the first example is qualifying travel. You are a railroad conductor, and you leave your home terminal on a regularly scheduled round-trip run between two cities and return home 16 hours later. Well, for a tax preparer, that might be a normal day's work, 16 hours in the tax season, right? But for a conductor, that conductor needs to rest. So during the run, you have 6 hours off at your turnaround point where you eat 2 meals and rent a hotel room to get necessary sleep before starting the return trip. And IRS says that is qualifying travel. Even though you were gone less than a day, you pulled over, you took out a hotel room, and you rested for a good 6 hours. Example number 2, this is not qualifying travel. You are a truck driver. You leave your terminal and return to it later the same day. You get an hour off at your turnaround point to eat, basically lunch break. Because you were not off to get necessary sleep and the brief time off is not adequate for rest, you are not traveling away from home. Temporary assignment or job. If you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses subject to the following. Number 1, the assignment must be considered temporary in order for you to claim the expense. So we're looking at this heading up here, temporary. What does that mean? And the assignment has to be temporary in order for you to claim the expense as a travel expense. A temporary assignment is one that you realistically expect will last 1 year or less, and does in fact last 1 year or less. Now this is not a hard item or concept to remember because in a way it coincides to IRS's definition of long-term versus short-term. If we were to move over into a discussion of capital gains and whether or not my gain from the sale of an asset was long-term or short-term, long-term is more than a year and short-term is 1 year or less. When it comes to temporary for travel expenses, IRS says temporary is a period of time equal to 1 year or less. And if your assignment is more than a year, it is not temporary. So your client comes to you and they say, yeah, I took up a job in a neighboring city and I'm going to be there for the next 18 months. Am I allowed to claim travel expenses because I have to take out an apartment there? What just happened? Well, what just happened was my assignment is not qualifying as temporary because it is more than a year. Now, I might be able to claim moving expenses if I have to move to the neighboring city for 18 months, but I'm not going to be able to claim temporary living expenses while I'm there because it's not temporary. It is more than 1 year. Now, if your assignment is indefinite, expected to last more than a year, the location of your assignment becomes your new tax home and the cost is not deductible. So how do we determine temporary or indefinite? Because sometimes we may not exactly know how long we're going to be gone for. To determine if your travel is temporary or indefinite, you should apply the following rules. If you are indefinitely assigned to a work location, that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start work. You may claim temporary living expenses while you are away from home up until the day you first become aware that your assignment has become indefinite or will last more than a year. Well, how would that happen? Well, you could easily take up a temporary assignment. You've accepted an assignment that's going to last 6 months. You sign a contract for 6 months. You travel across the country. You take out an apartment for 6 months period of time, or you stay in extended living somewhere along that, or maybe you've got a family member. But you're gone for 6 months on this contract. And some point through that contract, the employer comes and says, hey, things have changed. The economy's picking up. We need you longer than we thought. Will you stay on another 6 months? You go, sure, I'll take another 6 months. At that point, your stay is still temporary. 6 months plus 6 months equals 1 year. It is not more than a year. So we're clocking forward, and we're at the 5th month point in the second 6-month period, and the employer comes to you and says, we'd like to keep you on permanently. And you go, hot dang, I've got a permanent job. That's stress off of me. I don't have to look for work anymore. I've got a paycheck coming in for sure. I accept. Well, on that day, you're no longer temporary. On that day, you know you have a job that will carry out more than a year. So you are going to be allowed to claim temporary living expenses for the first 11 months because at the 11th month period, that's the day you became aware that your assignment would go over 1 year. Now, members of the armed forces who are on permanent duty assignment overseas are not traveling away from home. Naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship for travel purposes. If you are on a probationary assignment with the understanding you will keep your job upon satisfactory completion of the probationary period, your assignment is considered indefinite for travel purposes and is not temporary and is not deductible. Now, what about going home on your days off? This particular paragraph, these 2 bullet points, comes from Pub 17, page 179. If you travel home on days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would cost you had you stayed in your temporary home. This rule applies only if you are assigned to a temporary work location away from your tax home, and if your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses you pay for your temporary home or meals. So what this is saying is, all right, I'm in Portland, Oregon, and I accept a temporary job in Seattle. And I drive Seattle, for those of you who don't know how far Portland and Seattle are apart, Portland and Seattle are roughly 3.5 hours apart. So it's a long commute. You're definitely not going to be coming home every night. So you take up this temporary assignment in Seattle, and you drive to Seattle, and you stay in a hotel. And you check in on Sunday evening, and you work through Friday, and then Friday night you drive back home to Portland. Sound like a scenario people could do quite a bit, right? Now, is the travel back to Portland deductible? The IRS says yes, but only to the extent of what it would cost you to not come home. So how would we equate that? Well, okay, I'm not paying for hotel room on Friday night, and I'm not paying for hotel room on Saturday night, and let's suppose it's $100 a night. That would be a really cheap hotel room in Seattle, folks. That would be not the nicest hotel. So it would cost me $200 for hotel room in Seattle, and then my per diem meal allowance for Seattle for those 2 days would be another $71 a day, or another $142. So it would cost me a minimum of $342 to stay in Seattle for the weekend and not come home. That means my allowed expenses for traveling home from my family can be up to that. Now, if I'm claiming the standard mileage allowance, and it's roughly 200 miles each way, that means it's costing me $100 each way, claiming the mileage allowance. So it's costing me about $200 to come home rather than stay in Seattle for the weekend. And I can claim that $200 for coming home and going back. That's what they're saying with that particular rule. Now, there is a note here, and this comes from a different page in Pub 17, page 176. And it says, if your assignment away from your family home is indefinite or is expected to last more than 1 year, you cannot deduct any costs associated with traveling to your family home on your days off. However, if you travel away from your tax home to the vicinity of your family home for legitimate business reasons, you can deduct the cost of business travel to the vicinity of your family home. Deductible travel. The IRS considers travel expenses to be ordinary and necessary expense of traveling away from home for your business, profession, or job, and that an ordinary expense is one that is common and accepted in your trade and business, and a necessary expense is one that is helpful and appropriate for your business, and that an expense does not have to be required to be considered necessary. So if I'm going to claim a deduction for travel, now we're looking at the kind of travel. And in the cleanest, purest form of travel, it's entirely for business. The reason we travel is for business. But do you think it's ever possible that a person would mix vacation and travel? Or that they might try to call a vacation business travel? Say it isn't so. Well, obviously, clearly, the IRS knows that people do put vacation and business travel together. And one of the largest, or the largest nationwide forum that the IRS holds is in Las Vegas. So there are some rules about what to do when you have travel that is business travel and is also tied to side activities. And firstly, we're going to look at what happens when it is primarily for business. The IRS says that if your trip is primarily for business, you can deduct all necessary travel expenses, but you may not deduct costs associated with personal side trips or to lengthen your stay for personal reasons. And here's an illustration. Hawaii on the brain. This is a trip primarily for business, and you travel to Hawaii for a convention. The convention lasts 3 days, but you stay a week to enjoy a short vacation. You may deduct the costs of traveling to and from Hawaii and the costs associated with meals and lodging surrounding the convention. The costs for meals and lodging you incur during your additional vacation time are not deductible. Now, if the trip is primarily for personal reasons, you cannot deduct any of the travel expenses, but if you incur direct expenses while on your trip, you may deduct those expenses. So here we are on a personal vacation to Hawaii, and I'd like to somehow claim a business deduction because I went to a seminar. Well, here's what IRS has to say about that. You travel to Hawaii for a week's vacation, and while there you attend a one-day seminar related to your business. You cannot deduct any of the costs associated with travel to or from Hawaii. You cannot deduct the cost of lodging or meals while in Hawaii, but you can deduct the cost of attending the seminar. Costs of bringing family members and friends with you, the additional costs to do this are not deductible. Here's an illustration. You travel to Hawaii to attend a 4-day seminar. Your spouse decides to travel with you. Because of a package deal, you are able to purchase the cost of staying in Hawaii for 7 days is the cost of staying for 4 days. You can deduct all the costs of travel, meals, and lodging for yourself, but you cannot deduct any costs associated with your spouse traveling with you, and this is true even if your spouse assists you in performing your duties. Now, lots of people work in professions where the spouse is important. Having the spouse along and socializing is important, and there might be saying, you know, if I don't bring my wife, it's frowned upon. My job requires that I bring my spouse because we're going to be socializing with all of these upper echelon business people, and it doesn't matter. Not allowed to bring her. Or you can bring her, but you can't deduct her. There's a question in the classroom, what is the difference between a 1-day seminar and a 3-day seminar? You're looking at the facts and circumstances surrounding the trip. And how many people would travel to Hawaii for a single day? It could happen. But if you stay a week, it becomes very questionable. So that is where they're going to look at the facts and circumstances to establish when the trip is primarily for business and when it's essentially a personal vacation.
If you travel outside of the United States, you need to be a little more careful. IRS rules governing the deductibility of expenses for travel outside of the United States are different and more restrictive than for business travel inside of the United States. And the United States means the 50 states and the District of Columbia. How much of your travel expenses you can deduct depends in part upon how much of your trip was outside of the United States and was business related. You can deduct all of your travel expenses of getting to and from your business destination if it was entirely for business or was considered entirely for business.
Even if you did not spend your entire time on business activity, your trip is going to be considered entirely for business if you meet at least one of the following exceptions. Number one, there is no substantial control. That is, your trip is considered entirely for business if you did not have substantial control over arranging the trip. You do not have substantial control over your trip if all of the following apply. You are an employee who was reimbursed or paid a travel expense allowance, and you are not related to your employer, and you are not a managing executive. And if you want definitions of who an employer and managing executive is, go to Chapter 6 in publication. Actually, I think that's 463, not 563. Exception. Number two, outside of the United States for no more than a week. Your trip is considered entirely for business if you were outside of the United States for a week or less, combining business and non-business activities. And 1 week means 7 consecutive days. In counting days, do not count the day you leave the United States, but do count the day you return to the United States. Exception number three, less than 25% of the time is spent on personal activities. So clearly if you go on a 1-day seminar but you're traveling for a week, you've spent way more than 25% of your time on personal activities. Your trip will be considered entirely for business if you spend less than 25% of your time on activities and you were outside of the United States for more than 1 week, and you spent less than 25% of your time on those non-business activities. And then exception number four, vacation not a major consideration. Your trip is considered entirely for business if you can establish that a personal vacation was not a major consideration, even if you had substantial control over arranging the trip. So if you have travel that is primarily for business, but you do spend some of your time doing personal activities, the following rules apply. You can deduct the business portion of your cost of getting to and from your destination, but you must allocate or prorate other travel costs between your business and personal activities to determine the deductible amount. And rules for that allocation are in publication 463. Next up is meals. Now the IRS has something called entertainment and has something called meals. And we really only have meals, according to IRS, when we travel away from home on business, so that it's necessary to, well, eat. Locally, you have your box lunch that you can bring from home. So it's not necessary when you're at home to eat out and to buy food. But when you travel away from home, it is. So when the IRS talks about meals, they're talking about meals when you're traveling away from home. And if you eat locally in a restaurant, that typically is not going to be allowed unless you can show it's an entertainment activity associated with business. So we're going to talk about entertainment and meals, starting with meals. Unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for rest or sleep to properly perform your duties. For your allowable meal expense, you can use the actual cost of meals, or if you are traveling away from home, you can claim the actual cost of meals or the standard meal allowance. The standard meal allowance covers the cost of your daily meals and incidental expenses that you incur while you are traveling away from home. Incidental expenses include costs that you pay for fees and tips that you give to porters, baggage carriers, bellhops, hotel maids, stewards or stewardesses. Transportation between places of lodging or business and places where meals are taken, if suitable meals can be obtained at the temporary duty site. And mailing costs associated with filing travel vouchers and payment of employer-sponsored charge card billings. But incidental expenses do not include the costs of laundry, cleaning, and pressing of clothing, lodging taxes, or costs of telegrams or telephone calls. Per diem rates. Now, one of the things that happens with travel, and anytime you're buying food, is you're getting a lot of little Mickey Mouse receipts. You picked up a Starbucks at the airport, and that cost you $2.50. And then you might have taken a chocolate bar from a vending machine because you were starving and that was the only thing handy. And then you're walking into the hotel and there's a little deli counter, so you pick up a sandwich. And keeping track of all of those items can be, well, irritating and difficult. So there says, well, you don't have to do that. It's enough to just show that you were on a business trip, and if you were on a business trip, you can claim a flat dollar amount per day for each day you were on business. And that flat dollar amount is referred to as the daily per diem rate amount. The daily per diem rate amount will vary according to the city and country you are visiting, and the rates are published by the U.S. government and updated at least annually. The rates for travel are divided into categories, and one of those categories is called travel within the United States, the continental United States, and it's also referred to as CONUS. The daily per diem rates are revised each year for CONUS on October 1st. The last 3 months of the year, taxpayers can use either the per diem rates that come into effect beginning October 1st of the year, or they can use the per diem rates already in place for the earlier part of the year. But you have to use either the current rate or the revised rate consistently for all travel during that period. For 2011, there is a standard rate that applies to the country as a whole. If you don't know what the higher per diem rate is for a city, you can just claim the standard rate, although the standard rate typically is lower than most cities. But if you're just traveling throughout a state, and sometimes you're in high-cost areas, sometimes in your low-cost areas, you're not even keeping track of where you are on each day, then you can just go with a flat $46 a day. But obviously $46 a day, if you're in a high-cost area, would be losing out on a good deduction. And how you go to find out what the higher deduction rate is for a particular city or region is in publication 1542. You can also get the information off the internet, and I will show you how to navigate the internet to find that information shortly. But if you were to go to publication 1542, you would be able to see tables that are in that publication, and those tables allow for higher rates. For example, the higher rates could go up from $46 a day to $51, $56, $59, $61, $66, or even up to $71 a day for travel inside of the continental United States. Examples of cities that fall with the highest $71 rate, they're usually the big metropolitan areas. Los Angeles, Seattle, Las Vegas, Chicago, Washington, D.C. are examples of $71 a day cities. In the $66 category, we have my hometown here, Portland, Oregon. We also have Philadelphia and San Antonio. Those are all $66 a day cities. Milwaukee, Wisconsin, and Salt Lake City are both $61 cities. Virginia Beach, Virginia, and Vancouver, Washington are $56 cities. And of course, to read you every city, we'd have to go through all of the publication, which I'm not going to do. That's your job as a tax preparer to go look it up when you need to know it. Quick Finder, if you have Quick Finder handy, under the 2106 tab, there is a 2106 tab in Quick Finder. You want to hand me that, Eve? I have one of the attendees here in my classroom just happened to have a Quick Finder as I was mentioning it. This is Quick Finder right here. And every tax preparer worth their grain of salt usually has one of these handy.
next to them throughout tax season, and if there's only one in an office, everyone's fighting over it. Where's my quick finder? Who took my quick finder? Well, tab number 9 in this quick finder is where you can go for 2106 information, and at the back of that tab, we've got the meals and incidental per diem rates. So this is just a quick handy reference that I keep next to my desk, and every time I want to know the per diem rate for a particular city, I just flip it open and find it. Chattanooga, Tennessee, those of you who wanted to know, it is $56 a day. Now, if you go to publication, what is it called? Publication 1452, and you look for the tables in it, you will see the tables look something like this. And I just cut out a table here for Arizona. You can't see the headings that are going across the top of it, but you can see some numbers. And one of the numbers is 77 up here for Grand Canyon, Flagstaff. But when you come down to Scottsdale and Phoenix, you'll see it's 126. Well, where is that higher number coming from? And then what is this 197 number? Well, if you take 126 and you add 71, you do get 197, right? So that's where the 197 comes from. But what's the 126? Well, the 126 is the lodging per diem rate. And the lodging per diem rate is something that employees don't get to claim for themselves. And it's also something that self-employed people don't get to claim for themselves on Schedule C. The lodging rate is an amount of money that an employer can give an employee to compensate them for their lodging expense while traveling. The employer can just outright give an employee $126 of cash for each day that employee is traveling in Phoenix or Scottsdale. That employee can use that money to pay for the hotel room, and if the hotel room even costs less than that, they could keep the difference with no tax consequence. If the hotel room costs more than that, then the employee could deduct less. But essentially, this is an allowance that the employer can give that employee tax-free. But as a self-employed person, you're only going to be allowed to claim the actual cost of your lodging. And as an employee paying his or her own travel expenses, you're only allowed to claim the actual cost of lodging. But we contrast that with the meal expense, which is in this column right here. And for the meal expense, it doesn't matter whether you spend $71 a day or not. You get that deduction. You get to claim it. Now, what else we'll see on this chart is that it is mentioning Phoenix and Scottsdale, but it's also mentioning something called Maricopa. And that is the county that Phoenix and Scottsdale are in. And what this table is telling you is even if you're not actually in Phoenix or Scottsdale, maybe you're in a suburb of those cities, if you are in fact in Maricopa County, you will still get that city higher rate. So lots of people travel to a city, and I'll say, okay, well, what city did you travel to? And they'll tell me, well, I was in Bellevue, Washington. Well, Bellevue is a suburb of Seattle, and it's a very expensive suburb of Seattle. And if I open up and look inside publication 1542, am I going to find Bellevue? Well, I might. Just sitting here, I don't know if I will or not. But is it inside King County? And King County is the county that Seattle is in. The answer is yes, it is. And so the King County rate would be $71, and that's what we would go for, whether or not it specifically mentions Bellevue or not. And here we have Sedona. Within the city limits of Sedona, you get $66 a day. And if you're in Sierra Vista, anywhere in Cochise County, it's going to be $46 a day, which is the lowest rate. There's no special rate. So that's how you read these tables. Now that's for travel inside CONUS. Per diem rates for travel outside of CONUS are different, and you're going to go to different reference sources for those. The Department of Defense establishes per diem rates for Alaska, Hawaii, Puerto Rico, American Samoa, Guam, Midway, and the Northern Mariana Islands, the U.S. Virgin Islands, Wake Island, and other non-foreign areas outside of the continental United States. You can access per diem rates for these non-foreign areas at the following URL, Defense Travel Department of Military, or Department of Defense. Then we have daily per diem rates for travel to foreign countries, and these vary depending on the country and the city visited and even the month that you visit those cities in. The Department of State establishes per diem rates for all other foreign areas, and for international per diem rates, you should go to this URL right here. Now, if you are an online student and you open up the PDF document of this particular manual, you can click on the link, and it'll take you right to these. I can actually just navigate to the internet, quickly type a search engine, and I'll get there just as fast. Now, if I were to do that and look up specific cities on specific dates,
somewhere else in the world, these are some of the numbers I would find. Vancouver, Canada, if you traveled there in October of 2011, the per diem rate for that city is $120 a day. If you traveled to London in November of 2011, that city is $182 a day allowed for food. It's not the lodging rate, that's the food rate. Kuala Lumpur in Malaysia, September 2011, the rate is $77. Hong Kong, $144. Now the island of Kauai, $92 a day. I found that interesting. That was the most expensive island in Hawaii, was Kauai. And then Fairbanks, Alaska, not so cheap there either, $86 a day. Now, I did want to give you a caution again. You have to be careful when you're looking at those rates to grab the meal rate, and in most cases, invariably, the higher number is the lodging rate, and yes, you get to use the lower number. Now, what happens on the per diem rate rule for the day you arrive in home or leave home? Because you're not gone for a 24-hour period in the day that you leave. What do? Well, IRS says for travel days to and from home for a business trip, you must prorate your standard meal allowance, and you can do so by one of two methods. Method number one says you can claim 3/4 of the standard meal allowance. Method number two says you can prorate using any method that you consistently apply and is in accordance with reasonable business practice. And one of the things I've seen would be reasonable business practice would be to take the entire per diem, as long as you're consistent and always do it, and it's normal business practice. Now, obviously, if you took the early bird flight home and arrived home at 8 a.m., taking the entire day would not be allowed, or reasonable. But IRS says that 3/4 of the daily rate would still be allowed. 50% limit on meals and entertainment expense. Whether you claim your actual expense or the standard meal allowance, you can only claim 50% of your allowable expenses. Now, I did want to just take a minute here because I've promised that I can get you to the IRS website or the federal websites where you can look up these per diem rates for yourself. And I can tell you and then I can show you, and I may as well show you. So I'm just going to the internet here, and I'm going to go up in my search engine and type federal per diem rates and see what comes up. Oh, that didn't take me long. Oh, here we are. Click on a map. All right. What happens if I'm going to foreign areas? Because this is a map of the United States. Can I do something if I have foreign travel? Department of Defense, visit here. Foreign rates, click here. Oh, it's all on one page. Okay. So now I'm on the Department of State site, and I want to find a federal or a foreign per diem rate. Let me see if I click that link. Oh, find the country. All right, I don't know, Austria. Let's go there. So now that I'm in Austria, I have to pay attention to the date. We're in the month of May, so oddly enough, it shows May 2012. But if I'm looking up a per diem rate for my client who traveled to Austria in April of 2011, I would have to select that date, and then I click Go. And now it's showing me the cities in Austria, and which of those cities am I going to go. And here is the meal rate for Austria, $142 a day if you are in Graz. And Innsbruck is $137, and the big expensive one, Vienna, at $163 a day. And you can see the lodging rate paralleling it right here is the higher number. So simple to get what you want. Now if I go back and I go back to that US map, and I just want to randomly pick, I don't know, Texas here. Here are all of the regions inside Texas. And we've got the standard rate, and we have the meal rate here in this column. So all of these rates in here, those are the lodging rates, and meal is all by itself. It's the tiny number on the edge. Don't get distracted by big numbers and think they're for you. The highest rate allowed anywhere inside continental United States is $71 a day. So if you see a number higher than that, you know you're in the wrong column. It's only outside of continental US that you'll get a number higher than 71. Alrighty. So now let's look at the per diem rules for transportation workers who fall under hours of service limits. You can deduct 80% of your business-related meal expense if you incur the meal expense while subject to the Department of Transportation hour of service limits.
These limits generally affect the following categories of workers: airline pilots and flight attendants, train conductors, and interstate truckers. In addition to being allowed to claim 80% of the meal expense rather than just 50%, workers who are subject to hours of service limits are allowed to use higher daily per diem rates than the $46 rate allowed for non-transportation workers. The higher rates are as follows. If you are inside of CONUS, it's $59 a day. And it actually, yeah, and then if you're outside of CONUS, it's $65 a day. So if you're a trucker in Alaska, for example, $65 a day. Now there is some information in here I wanted to give you about Amtrak. It hasn't really got so much to do with the deductibility of business expenses on Schedule A, but I figure when we're talking about transportation workers who get higher daily per diem rates, I'd also mention the Amtrak Act because it is rather significant. If you are a transportation worker defined under Amtrak, your income from work performed in more than one state is protected from taxation by more than one state. The Amtrak Reauthorization and Improvement Act of 1990 prohibits states and local governments from taxing compensation of certain non-resident employees who have regularly assigned duties in more than one state. If you are a federal, state, or local government employee, you may not exclude your income under the Amtrak Act. U.S. Postal Service employees are considered employees of the federal government. So who qualifies? To qualify under the Amtrak Act, you must work for an interstate railroad, an interstate motor carrier, or an interstate motor private carrier. A qualifying person or employee of an interstate motor carrier or motor private carrier must directly affect the safety of a commercial motor vehicle, which essentially means you're driving it or you're directly hands-on nature with that route. And if you can show that you're direct hands-on nature with the transportation of people or materials, you're going to be able to fall under that Amtrak Act. And then it says you must work as an operator, a mechanic, a freight handler, or someone other than an employee who directly affects the safety of the motor vehicle. And then it goes on to talk about what a motor vehicle is. So the point in all of this is that if you have a person who is an interstate transportation worker who falls under the hour limits, they're going to be able to claim a higher daily per diem rate, and they're also going to be able to claim 80% of that daily per diem rate as a deduction on Schedule A. And that's one side of it that is associated with Schedule A. The other side of it is when it comes to do their state tax returns, they should in fact only be paying tax to one state on their income, even if the income was derived from work performed in multiple states. And that rule applies only to people who fall under the Amtrak Act. So let's look at an example of a contrast to that. I can remember, it's odd that these two incidents are together in my mind, but they are. I feel like I was traveling on a business trip, and while I was traveling on this business trip, it's right around 1991, the Rodney King beating was in the news. And at the same time, there was something else newsworthy in the news. And back then, I wasn't in taxes. It was just before I entered the industry. There's something about some football player losing a lawsuit or anyway, the rule was that some football player who'd been playing football in a particular state that wasn't his home state was going to have to pay tax to that state. Now you figure if you're a football player or any athlete on any sports team traveling around the country playing games, what that's essentially saying is, yeah, you would need to have to file a tax return for every state that you worked in, played a game in, and had income from. Now, are there people other than athletes where this might be an issue? Well, if you're a traveling musician, traveling artist, that would happen. But I've also had it with people who are electricians. One year here in Oregon, we had some flooding and a big windstorm that knocked down a bunch of power lines all over the state. And for quite a period of time, we had electricians coming to our state from other states. And I was doing their tax returns, and I was seeing electricians who had W-2s that they'd bring in from that were allocated for 5 different states. It was all the same employer, but 5 W-2s, each W-2 for a separate state, the same employer, and we had to file 5 state returns. So the rule is that a state, typically, if it has an income tax, is going to tax you for pay you receive for services performed in that state, regardless of whether you're a resident, and regardless of whether you're kind of just passing through for a few days. They want their piece of that pie. And for that reason, and because of the nature of the work performed by transportation workers, The Amtrak law was passed so that these interstate transportation workers weren't going to have to worry about filing a tax return with the state of Arizona because the big rig truck they were driving passed through that state for a period of 5 hours. All right, so that's what it's about. So we're going to pick up in our manual with entertainment expenses next. We left off before the break having talked about meal expense. Now we're going to talk about something that kind of partners with meals in a way. Entertainment is similar to meals because it, like meals, is subject to a 50% limit. But the description or the identification of a meal expense compared to an entertainment expense, there's different rules. And the IRS says you can deduct ordinary and necessary entertainment expenses provided they are directly related to business or associated with business. Directly related to business means all of the following are true. You expect to derive income or some other specific business benefit other than goodwill at some future time, but it is not necessary to demonstrate that you actually get the benefit. Or you actively engage in a business meeting, discussion, or other bona fide business transaction with the person you are entertaining, and the principal purpose of the combined business entertainment activity is the active conduct of your business, but it is not necessary to devote more time to business than to the entertainment to meet this activity. Now, inside Publication 463, the IRS does give some examples of places that would not be possible to have a business discussion. For example, a sporting event. You're in a noisy stadium at a football stadium. Is it at all possible to have a business discussion there? You might get a few words in when things are quiet enough, but for the most part, it's going to be distracting and too noisy. Probably you can't do it. Same thing at a nightclub. Noisy, head-banging music, you're not going to be able to have it there. So is the IRS going to say no to entertainment at those facilities? Well, not necessarily. It's just that those facilities are examples of facilities where IRS says it's not possible that the entertainment is directly related to business. You're going to have to look for the next category, which is associated with business. So when is an entertainment associated with business? Because if you can prove that it was associated with your business, it can still be allowed. If your activity does not meet the directly related test, it may still be deductible if it satisfies two conditions. Number one is that the activity has a clear business purpose and the entertainment directly precedes or follows a substantial, bona fide business discussion generally allowed within a 24-hour period. However, circumstances could allow it to fall outside of that 24-hour period. Here is a caution. The 50% rule applies to entertainment and meal expenses only. Meal and entertainment expenses should be listed separately and never lumped together with other employee business expenses. For example, I have noticed that QuickBooks software seems to be preloaded, and other people are preloaded in their bookkeeping efforts, to lump travel and meals together as a single expense line item. Well, allowable travel other than meals and entertainment is not subject to the 50% limit. So when you lump it all together, do you apply 50% to all of it or none of it? Well, neither of those is accurate. You need to pull out those two categories and separate them and make sure you're applying the 50% limit where it needs to be. Business gift expense and the $25 limit is the next rule that we're looking at. You can deduct up to $25 per year per client for the cost of gifts you give in the course of your trade or business. Gifts you give to family members of a customer are considered to be gifts given to that customer. Refer to Publication 17, page 182 if you don't believe me. Exceptions to the $25 gift rule. Does anyone here not believe me? Exceptions to the $25 gift rule. The following items are not included in the $25 limit for business gifts. If you happen to give your client an item that costs you $4 or less, that has your name clearly and permanently imprinted upon the gift and is one of a number of identical items that you widely distribute. Examples include pens, desk sets, and plastic cases. The $25 gift rule does not apply. Also, the $25 gift limit does not apply if you give your client or your customer signs, display racks, or other promotional materials to be used on the premises of the business of the recipient. So clearly, those point of purchase displays, some of them can be very expensive, you know, hundreds or thousands of dollars. That's not going to fall under that gift rule because, quite frankly, it's a marketing or advertising expense, isn't it?
Now here is a class exercise to see if you comprehended everything I just said in that short half page. Jacob gave the following unreimbursed business gifts during the year. He gave a gift to a client named Mike, and he gave him a $15 gift. And, you know, he couldn't neglect the wife, so he gave Mike's wife $15 as well. Well, he didn't give her 15, but he gave her a gift valued at 15. Then he also gave 4 staff members of a corporate buyer gifts totaling $100. So kind of bought the same gift, but the cost of all of the gifts combined was $100, and he gave it over. And then Janice, a business client, he gave her a gift costing $75. So his total gift expense for the year is $205. What is the allowable gift expense that Jacob can claim on his tax return? And of course, for those of you who are cheating, I got the answer right here on the screen in front of you. It is $150, but where are we getting the $150 from? Well, Mike and his business and his wife, the value of the gifts given to the two of them combined is $30, and $30 is more than $25, so the limit will be a $25 deduction. On the 4 staff members, we're assuming $25 per staff member here. That's going to be allowed. $25 per person, so we're going to get all of the $100. But when we get down to Janice, her $75 gift, the deduction is going to be limited to $25. So in effect, we have we have $25 for Mike and his wife, $100 for the 4 staff members, and $25 for Janice, and that's where we get $150. Session 10 password number 2 is OCEAN, O-C-E-A-N. Local transportation expenses. Local transportation expenses are not travel expenses. However, certain local transportation costs are deductible. Local transportation costs include ordinary and necessary costs of all of the following. So we have been talking previously before the break about travel. And we have to establish that the travel is associated with a temporary business activity away from your tax home. But what about if you're not traveling away from your tax home and you're local, in the area of your tax home? Can you claim transportation expenses in the area of your tax home? And the IRS says yes, but not as travel. Don't call local transportation travel. It's going to be local transportation. Certain local transportation costs are deductible. Local transportation costs include the ordinary and necessary costs of all of the following. Getting from one workplace to another in the course of your business or profession when you are traveling within your tax home, and visiting clients or customers, or going to a business meeting away from your regular workplace, or getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within your area of your tax home or outside of that area. There is a caution, though. Local business transportation does not include expenses you have while traveling away from home overnight. So you've got to keep them separate. So when we have a temporary work location and when don't we? A temporary work location is one that lasts a year or less. When you travel away from home, can you claim travel? Yes, if it is for 1 year or less. When you're talking about local transportation expenses, can I claim those? The answer is yes, if the employment period at that particular job site will last 1 year or less, subject to some other rules. So you'll see that there's this tendency of 1 year or less is the rule that applies to all of them. If you are assigned to a temporary work location in the local area of your tax home, you may be able to deduct a transportation expense subject to the following. If you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of the daily round trip between your home and that temporary location. If you have no regular place of work, but ordinarily work in the metro area where you live, you can deduct daily transportation costs between home and a temporary work site outside of that metropolitan area. Well, can anyone think of an example of a person who has no fixed work location in their tax home metropolitan area,
that could travel outside of the metropolitan area for work. What would be an example of that? They have a tax home, it's the metro area, but they don't have a fixed work location inside of that metro area. Who would have that? Can we think of anyone? Those of you who are online can text me if you can come up with it. Let's see who comes up with the answer first. Construction, thank you. So construction worker is a very good example. You are a bricklayer. Do you lay bricks forever at the same work location? Probably not. Do you have an office that you work from? A place that you check in each day? Probably not. You probably have an employer that you work for, or maybe even 2 or 3 employers that you work for in any given year, and they call you when they have a job project for you, and you go and you work on that job site, building your brick wall or your brick sidewalk or whatever for the period of time that that job lasts for. And usually it's well under a year. Might be a few days, a few weeks, a few months. Just depends on the size of the project. And for that reason, you really don't have a regular fixed work location. So you can't say that I have a fixed work location if you don't. And therefore, you can't say, well, I worked at this job site for 3 months, and then when that job site ended, I went and worked at another job site, so that other job site is temporary, and I can deduct my travel from my home to that temporary job site. That's not allowed. Let's compare that with a job site description that is allowed. I am a manager at a supermarket. I run the store. And I've been in charge of the store for the last 5 years, and I'm really good at it. And there's a store across town that's got some problems. So my district manager says to me that he wants me to go manage this other store for 6 months, help bring it up to snuff. And my assistant manager at my store, who's been under my guidance and direction and education for the last 5 years, he can handle things for the 5 months that I'm gone. So I say, okay, cool. Now that's an example of I have a fixed work location. It's a normal place that I work. Now I'm traveling to a temporary site in my metropolitan area for 5 months. And I can deduct the cost of traveling from my home to that temporary job site at that other supermarket for the 5 months. Back and forth every day commute, I get that. But the construction worker who cannot show that he has that regular fixed work location and works at one job site in the metro area and then works at another job site in the metro area cannot claim any of the commute to either of those sites from home to work. Question, yes? Yes. So the question in the classroom is, it seems a little bit odd that if you drive from your home to your regular job, that's non-deductible commute. But if you drive from your home to a temporary job, that is deductible? Why? Well, the rules say it is. That's why. And the rules say it is because you have a regular fixed work site and you are temporarily traveling to a different site. They allow it. Now, if you are a construction worker and normally you have a fixed metropolitan area that most of your work is in, or at least you attempt to make it there, but you accept a work location outside of metro, now you can claim it. So I'm the bricklayer, and I have my home here in Beaverton, Oregon. And whenever I possibly can, I get a job somewhere in Portland or the metro area of Portland, and Beaverton is a suburb of Portland. So whenever I can do that, I take a job in Portland. But times are tough, the economy is tough, there's not a lot of jobs for bricklayers, and so I accept a bricklaying job, let's just pick in the neighboring state of Idaho. And so I travel to Idaho, and I spend 3 months in Idaho working on a job site. And on weekends I travel home, and while I'm in Idaho, I pay hotel. That would be an example of where the travel will now be deductible. It actually is travel. You're staying away overnight. So let's take a look at these transportation costs and compare those with commute. Because the IRS says commute cost is never deductible. And it identifies commute as the cost of driving to and from work within your metropolitan area. Commute is never deductible, and the following transportation is considered commute. Driving to a temporary job site when you have no regular work location. If you do not have a regular job location, you cannot deduct daily transportation costs between your home and a temporary work site within your metropolitan area. These are non-deductible commute. Driving from a home to a second job. You cannot deduct the cost of traveling from home to a second job.
If you have 2 places of work, the following rules apply when you work at 2 or more places of work in the same day. You can deduct the expenses of getting from one workplace to the other. But if for personal reasons you cannot go directly from one work location to the next, such as a detour to visit your doctor or buy groceries or pick your kid up from school, for example, you can only claim the cost equivalent to what it would have cost you to travel directly from one work location to the next. So this is a table straight out of Pub 17 again. This one is on page 183. It's a very nice chart. Here's home. This is where you live. And we have the regular job. We assume you have a regular fixed work location. And if you do, the travel from home to that regular job is never deductible. And then we have home to our second job. That is never deductible either. Then we have regular job to a temporary job. That's always deductible. And regular job to the second job in the same day is always deductible. And a second job to a temporary job is always deductible. And home to a temporary work location is deductible if you have a regular or main job at another location. Parking, next item in line. Fees you pay to park your car at your place of business are not deductible. They are commute expenses. You can deduct the cost of business-related parking expenses only when you visit a customer or a client or you attend a meeting away from your normal work location. Now, some employers provide employees with free parking, and employers are allowed to provide a limited amount of free parking to their employees. If you work in one of the skyscrapers in downtown New York, I would predict it's fairly expensive to park there. And your employer might pay the cost of that parking for you. There is a limit on how much free parking your employer can give you in a day or in a month. I can't remember, they've changed it. $143 a month or $215 a month, it's somewhere in that range that the employer can give you as a tax-free fringe benefit. But I would imagine parking in downtown Manhattan would be more than that. Now, if your employer pays all of your parking for you and the cost of the parking is more than the maximum amount that the employer is allowed to give as a tax-free fringe benefit, the difference between what they pay for that parking and that max amount they're allowed to give tax-free, that would have to be a gross up on your W-2 and you'd have to pay tax on it. But that's a rule for employers. Let's just flip over to where we're sitting today, which is I'm the employee and I had to pay to park to go to work. My employer is downtown, and the only place to park downtown is in the parkade, and that parkade costs money, so I pay a monthly amount. Can I deduct that? The answer is no. Not allowed, regardless of the amount. So when can I deduct parking? Well, I can deduct parking because I went to a business meeting, and I drove, I parked my car, I paid to park it, and I went to the meeting. Or I have a temporary job location, expected to last 1 year or less, and I have a regular fixed main work location, and while I'm traveling to this temporary location, I'm allowed to deduct the cost of parking. Next topic is auto expenses. If you use your car for business, you can claim the actual cost of operating the vehicle, or you may be able to claim a standard mileage allowance. Whichever method you use, you have to keep adequate records to prove your expenses. And I have a table here to show examples of deductible local transportation and non-deductible local transportation. Commuting from one job to another job in the same day is deductible transportation. Fees for parking while attending a meeting away from your normal work location, deductible. You can also claim the cost of putting an ad on your car. You can claim the cost of operating a for-profit carpool, which you operate as a business, and you can claim added costs you pay because you haul tools or instruments to work. What can you not deduct? You may not deduct the cost of commuting to and from your job, nor fees for parking while you are at work. Also, advertising displays on your car do not create a business use of the vehicle. That still has to be tracked separately. You cannot claim the cost of your share of carpool expenses that you pay to travel to and from work. The fact that you haul tools or instruments to and from work does not mean you are using your car for business. And union member trips to a union hall are never deductible. That is in the IRS publications. That's a no. Standard mileage rate for 2011, the standard mileage rate is 51 cents for each mile driven before July 1 and 55.5 cents for each mile driven after June 30th. The following rules apply if you want to use the standard mileage rate. You can claim the standard mileage rate instead of the following: depreciation, gas, insurance, lease payments, licenses, oil changes and other maintenance costs, registration fees, repairs, and tires. Also, if you want to use the standard mileage rate, you must generally choose to use the standard mileage rate the first year you use your car for business. You cannot claim actual expenses on a car that you lease rather than own, or pardon me, if you claimed actual expenses on a car that you lease rather than own, you cannot claim the standard mileage rate in a later year. So IRS says you can use the standard mileage rate on a leased car, but it has to be the first year you lease that car for business. If you choose the standard mileage rate, you cannot claim actual costs for operating the car in the same year. That stands to reason. But even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls. Those are not factored into the standard mileage rate. They are separate. You cannot claim the standard rate if any of the following is true. You operate 5 or more cars at the same time for your business. If you do, you are considered to operate a fleet and must claim actual expenses. Or if you claim depreciation on the car in an earlier year, or you claimed a Section 179 deduction on the car in an earlier year, or you are a rural mail carrier who received a qualified reimbursement, or you claimed actual expenses on a leased car. When claiming the standard mileage rate, you will multiply the number of business miles driven by the mileage rate. Let's compare mileage rate to actual car expenses. You can claim actual cost of using your car for business purposes, and this is kind of a repeat, but the types of expenses you are allowed to claim as actual expenses include depreciation, car rent and parking costs, gas, oil, and maintenance, insurance, lease payments, license and registration fees, repairs and replacement tires, and tolls. Even if you claim actual expenses, you still have to track the number of business miles you drive so that you can prorate the costs between business and personal. Here's one of the things I run across with clients. How many of us have clients that are not so good at keeping mileage logs? I don't know, one client in 100 seems to actually keep a good log and do so religiously, like their life depends on it. I find it odd because clients come to us because they want tax advice. They want us to do an accurate tax return. Year after year, we tell them to keep a log, and year after year, they don't do it. And why? Because it's a pain in the butt. That's why. Everywhere you go, you got to look at the odometer, write it down, add it up. I can't be bothered with that. Maybe while I'm sitting at the red light. Oh, someone just honked at me. Oh, the light turned. Okay, so it's just people don't like to do it. So then they come in to have us do their taxes, and here's the line I get. Well, I didn't keep a log, so I just want to claim actual expenses this year. No mileage rate, I'll just claim actual expenses because I didn't keep a log. Well, whether you kept a log or whether you want actual expenses or the standard mileage rate, you still have to keep a log. And here's why. You drove your car 15,000 miles during the year, 10,000 were personal miles, and 5,000 were business. Your actual cost for operating the vehicle totaled $7,000 for the year, and you figure your allowable deduction as follows. You take 5,000 business miles and divide that into or by 15,000 total miles, and then you multiply that number by 7,000, and your deduction is $2,333. So you still have to figure out what the percentage business use is, and the only way you can figure out the percentage business use is by tracking the use of the vehicle. Now, do I have to keep a log, a perfect log, day to day for my business? Well, if you read that publication 463, it will tell you, no, you don't. Is it enough to do sampling? Is it enough to keep a record in some other form? The answer says, the IRS says yes. It is acceptable to keep your proof in another form other than a perfectly kept mileage log. But their favorite form is the mileage log. That's the first thing they're going to ask for. But they will accept other things. For example, one year, my bricklayer, he got audited. And every year he came into me with his mileage log, and he had it all laid out. how much he'd done. And one of the things the auditors ask for is, when did you do oil changes? Or, if you go to Jiffy Lube, can you show us mileage odometer readings taken by Jiffy Lube or the places that you've been at the start and the end of the year, so that we can see that if you're saying you drove 20,000 miles on your car during the year, that someone took an odometer reading that is verifiable at the beginning and end of the year, or at a time frame approximately around that, so that we can show, yeah, you did drive 20,000 miles. But my bricklayer, he does his own oil changes. But he belongs to this bricklayer union, and they seem to talk to each other because his mileage record actually had written in it when he did his oil change and the odometer readings that he took. So obviously there was some special ed class for bricklayers at any rate. So that was my bricklayer guy. So that part of his audit went pretty good. He had a nice clean mileage record. But then there was the other construction worker I had. He went on a business trip to Seattle, and he was in Seattle for months. And he was like a foreman type position, constructing something to do with the airport there. It was a long project. He was there for a while, not more than a year, but he was there for several months. And when he came and had his tax return done, he said that his mileage was this number. I'm just going to pull a number out of my hat. He said it was 20,000 miles. He had no log. He had literally pulled that number out of his hat. Oh, it must have been 20. So he told us this. And then he got audited. So, of course, the first thing I asked for is the mileage log. Well, I lost it. Okay, then. So then it was on to some other expenses. We'd claimed some business expenses for him on his tax return. He didn't have records for any of those either. He had 0 records. And big deductions that he'd claimed, because clearly he'd been up in Seattle for a long period of time. So it was a great deal of work to reconstruct his tax return for the auditor. But there was a couple of interesting things that I learned through this process. There is the ideal world where you do all of this work and it means something and the auditor accepts it. And then there's this world where nothing you do will satisfy them. Well, this was a world where everything I did, she was happy with. It was very interesting to see that what seemed logical to me was acceptable to her. The logical place I started was, okay, how far is it from your home in Beaverton, Oregon to the work site and the hotel you stayed at in Seattle? And I get MapQuest out and I type it in and MapQuest it. And it gives me this round trip distance. Let's just say 200 miles. And how many times did you drive it? Well, I was there for 9 months. And I drove it once a week back and forth for 9 months. So that we were able to come up with a pretty good number. And then how far was it from the hotel that you stayed in to the work site? And we were able to MapQuest that and come up with a number. It got more confusing because he didn't always stay at the same hotel. He kind of moved around. So we had to figure out what hotels he was at from his memory and then call those hotels and ask them to look in their computer systems to find him, which isn't always easy because he's getting audited on a 2008 return in 2010, and they might have erased those records. But at any rate, we were able to come up with numbers that were supportable. What was interesting is that the numbers we came up with in no way matched any of the line entries on the tax return. The mileage was way off, the lodging was way off, but you know what? There had been no deduction anywhere on his return for meals. I didn't prepare the return. I would have gotten the meal expense. But anyway, I was helping him with the audit. So I'm going $71 a day, Seattle. He's there for 9 months. We mapped it all out. All right. So when we were done, he actually had enough expenses that the auditor made no adjustment to his return. It was a zero change audit. The best kind of outcome you could possibly hope for as a tax preparer. But it was not because the tax return was remotely accurate. So let's go back to this car information. And obviously, if we're going to be able to deduct car expenses, we're going to have to establish business use, and the IRS wants us to be able to compare or show how much business use there was and how much personal use there was. If you use your car for business and personal, you have to maintain adequate records to show your business use. Now, in the case of my client who had no mileage log,
What was supportable was that he was able to provide letters from his employers who verified that he had been assigned to Seattle. The employer could not verify the miles he drove on his car, but it was reasonable that he would have driven from Portland to Seattle for that period of time, 1 day a week. And he was able to show hotels that he had stayed in and the dates that he checked into those hotels and the days he was checking out. So the circumstantial evidence he was able to come up with around the outside without having the log was enough. But of course, the favorite is always the log. IRS says acceptable methods of tracking business use of your car include keeping a mileage log, and ideally the log will show the dates that you drove, the places that you traveled to, the miles driven, and the reasons for travel. Another really good solid option is using your personal calendar of appointments to log the miles driven for your appointments. If you're already keeping a log of your appointments, you already know who you're visiting, you already know the date you're going there on, the only thing you need to add in is, well, how far it was. So that makes it easy. You may use actual expenses or the standard mileage rate in any year. However, generally you will not be able to claim the standard mileage rate in any year following a year where you claimed actual expenses and claimed depreciation on the vehicle. Now, is it possible to claim actual expenses and not depreciate the vehicle? Well, technically only when you don't know what you're doing. Because anyone who knows what they're doing would know you're supposed to depreciate a vehicle, because when you turn around and sell it, the IRS will treat you as having claimed depreciation whether you took it or not. Depreciation is essentially a mandatory treatment when it comes time to sell. So anyone who knows what they're doing would claim depreciation on a vehicle if they're claiming actual expenses. But if you happen to have a taxpayer who has filed a return, claimed actual expenses, but not claimed depreciation, then technically they could flip to claiming the standard mileage rate. Now, what about interest on car loans? Can I claim a deduction for that? Well, the answer to that question really depends on whether you are an employee claiming an employee business expense or whether you are a self-employed individual. If you are an employee and one of the business expenses you have is your car and you have an auto loan on that car, the interest is completely non-deductible. Interest on car loans owned by employees is considered to be personal interest, and with the exception of mortgage interest, personal interest is not deductible. But if you are self-employed, things flip. If you're self-employed, you can actually establish how much of the vehicle is business use and prorate the interest expense on that vehicle for the year as a deduction and claim it on the Schedule C. So yes, interest can be claimed on car loans on Schedule C, but no, interest cannot be claimed on car loans on Schedule A, or the Form 2106 that carries to the A. Now, what happens if I sell, trade in, or otherwise dispose of my car? If you sell, trade in, or otherwise dispose of your car used in your business, you will need to report the disposition of the vehicle on Form 4797. This is because you will need to determine whether you have a gain or loss on the sale or disposition of the vehicle. You determine your amount of gain or loss by subtracting the sales price of the vehicle from your cost after factoring for depreciation, and you have to factor for depreciation even if you claim the standard mileage rate instead of actual expenses. And here's an illustration of what I mean. Jan sold her 1998 Ford Taurus for $3,000. In earlier years, she claimed expense deductions for the car. Since Jan previously claimed a deduction for business use of the Taurus, she will need to report that sale on Form 4797. Illustration number 2. Instead of selling the car, Jan totaled it. It was not insured and she received no payment for scrap value. Since she previously claimed a deduction for business use of her Taurus, she needs to report the disposition on Form 4797. So Form 4797 is a completely other class. All the rules for filling it out, how to fill it out, those are handled in another one of our classes. I think it's called Sales of Assets, including Form 4797 and Schedule D. Now, how do you go about reporting employee business expenses? Well, you complete Form 2106 or 2106EZ and attach it to your return if any of the employee expenses you claim are for auto, meal, entertainment, or travel. If you have employee expenses that are not one of these 4 expenses, the form is not required. All other types of employee expenses can go directly on Schedule A, except, of course, for depreciation, which goes on 4562. And if you have a loss on the disposition of a vehicle, for example, that's a 4797 transaction. Something else I wanted to talk to you about are accountable versus non-accountable plans. The IRS looks closely at this, and every IRS audit I have ever been in that involved employee business expenses, the auditor was all over this.
They do not, that is the IRS does not want to allow deductions for employees who are not, or who are trying to claim deductions that are really not necessary or required for their work. They're suspicious and on the lookout for people who are just trying to claim write-offs that aren't really required for their work. So when we get into an audit, the first thing the auditor wants to see, at least in my experience, is a copy of the company's reimbursement policy. And I remember saying things like, well, this is a small employer. They probably don't have anything in writing. Well, you need to get a letter from them saying they don't have anything in writing then. Are you kidding me? No. Get me the letter. Okay, so all right. Get a letter from your employer saying they don't have a policy. All right, so they don't have a reimbursement policy, then how can you show that the expense was reasonable, necessary, ordinary for your job? You're going to have to look at the elements that are involved in it. Now, let's look at the type of person who might commonly have expenses and probably has an employer who has a policy. Let's try salesmen. I don't care whether you're selling advertising, shoes, refrigerators, or drugs to doctors. You're probably going to be working for an employer who has some kind of policy about employee expenses because that's the kind of occupation where you're surely going to have them. You're going to have travel, you're going to have meals, you're going to have entertainment, you're probably going to have your computer, you're going to have cell phone. Those are all the things that go in tie in with being an employee working in the occupation of sales. So the IRS wants to know what kind of plan you have as an employee. As an employee, you're going to be working either under an accountable plan or a non-accountable plan. Well, no plan at all would be an example probably of a non-accountable plan, right? Under a non-accountable plan, if your employer gives you an allowance for expenses with no requirement to report your expenses back, then you are in a non-accountable plan. And under such a plan, your employer should include any allowance, if they give you an allowance, in Box 1 wages of your W-2. And you should report all of your employee expenses on Form 2106 as if you had not been reimbursed. So let's look at the salesman. Has anyone here ever worked in sales? Ever? We've probably all done it. When we're out of college, first thing, it's the only place we can get a job is usually in sales, and I certainly did it. And one place I worked selling windows for Sears for a brief period of time in my younger years, we had a non-accountable plan. And I was given $100 or $200 a month for my car expenses. And it was grossed up on my W-2, and that was it. And then I kept a mileage log of everywhere I went, and I added up all of my miles and any of the expenses I had, and I claimed them in full as if I had not been reimbursed for them. And that is true. Because my employer included that allowance in my wages, all of my expenses are going to be fully deductible. But let's compare that with an accountable plan. If you are required to report your expenses to your employer and your employer subsequently reimburses you for them, then you are under an accountable plan. Under an accountable plan, you should not report your expenses and reimbursements on Form 2106 unless your allowable expenses are greater than your reimbursements. If your reimbursements are greater than your allowable expenses, you are required to if your reimbursements are greater than your expenses, you are also required to return that excess amount. So my employer gave me $100 to pay my expenses for a particular day or meeting, and I only spent $50. But I'm required to return the $50. That would be an example of an accountable plan where I have to return any excess that I'm given. But if I had the extra $50 and I didn't return it, then my employer is required to include that excess reimbursement in my income on my W-2 as a wage. Now, if your reimbursements are less than your actual expenses, you can claim the unreimbursed expenses as a deduction on Form 2106. So here's another table. This one comes from Publication 17, page 190. And we've got the three columns here. It says, if you are reimbursed under an accountable plan with actual expense reimbursement, adequate accounting is made, and the excess is returned to the employer, then no amount is reported by your employer on your W-2, and you do not file Form 2106, and you do not claim any expenses. Actual expense reimbursement, adequate accounting, and return of excess both required, but excess was not returned. Then the excess must be reported as wages in Box 1, and no amount is reported on 2106.
If you get a per diem or mileage allowance rate up to the federal rate, adequate accounting is made and the excess is returned, no amount is included in your wages, and all expenses and reimbursements are not reported on 2106 unless the form is otherwise required for some other reason or you spent more than was necessary or more than you were given. Per diem or mileage allowance up to the federal rate. Adequate accounting and return of excess required, but the excess was not returned. The excess amount to be reported as wages in box 1, and the amount up to the federal rate is not reported in box 12. It is reported in box 1. Pardon me. The amount up to the federal rate is reported in box 12, and anything above and beyond that is in box 1. So what that means is box 12 should identify certain amounts related to auto. And then in that case, any amount that is not deductible is not going to go on 2106, and any amount that was included in your income because it was not deductible is going to get included in box 1 wages. So 2106 is not required in that situation. Then we have per diem or mileage allowance exceeds the federal rate. Adequate accounting up to the federal rate only, and the excess is not returned. The excess amount should be reported as wages in box 1, and the amount up to the federal rate is reported only in box 12. It is not reported in box 1. All expenses and reimbursements reported on Form W-2 Box 12 only if expenses are in excess of the federal rate are claimed, and otherwise the form is not followed. So those are all examples. Essentially, you have an accountable plan. And the nutshell of an accountable plan is, in a perfect world, your employer either gives you the money up front and you have to account for it up to the amount that they gave you. And if you can't account for it, then any amount you can't account for you have to return to the employer. If you fail to return the unaccountable amount to your employer, that difference has to be included in your income as wages, and no deduction is allowed on 2106. Let's converse this. You have an accountable plan where your employer gives you a certain amount of money, but it's not enough. So you account to your employer for all of the money that you spent, but the employer doesn't give you any extra for the amount that you spent above and beyond that. It's the amount that you spend above and beyond that that you're going to be allowed to claim on Form 2006. Now let's compare that again with a non-accountable plan. Under a non-accountable plan, either with adequate accounting or return of excess or both, not required by the plan, no matter how much they give you, it's always going to go in box 1 as wages on your W-2. Your employer might give you, let's just say you're working at high-end sales, you're working for a pharmaceutical company, and your W-2 wage is $150,000 a year, and in addition to that, they give you $1,000 a month expense allowance. You can spend the $1,000 any way you want. If your expenses are more than that or less than that, it doesn't change. It's $1,000. And because you don't have to account for it, they include all of it in your income. If you have expenses that are more than that or even up to that amount, you're going to include all of it on 2106 because all of the income was put in your wage. Now, a non-accountable plan with no reporting of expenses, then the entire amount is also reported as wages in box 1, and you claim all expenses. So essentially, under non-accountable plans, any amount of money your employer gives you, it goes into box 1 wages, and therefore any amount of expense you have always goes on 2106. Under a non-accountable plan, you only use 2106 to report expenses if they are above and beyond the amount that your employer gives you. Here's an illustration of someone who has both a non-accountable and an accountable plan. Sally Smith is a union representative, and her employer gave her a $200 monthly auto allowance and also, on top of that, reimbursed her 14 cents per mile. During the year, Sally drove 14,000 business miles that were driven evenly throughout the year, 2,500 commute miles, and 20,000 total miles. Her round-trip daily commute was 10 miles. Sally also spent $500 on deductible entertainment expenses. Her employer reimbursed her $250 for these expenses. Since Sally is given an allowance she is reimbursed, she is on both an accountable and a non-accountable plan as follows. The $200 allowance is paid regardless of the number of miles she drives, and she is not required to refund that excess. The allowance is provided under a non-accountable plan. The 14 cent per mile reimbursement is paid only when Sally submits receipts and a monthly expense report. The reimbursements are provided under an accountable plan. So how should she fill out her Form 2106? Well, on line 1, she's supposed to enter her vehicle expense, and we're going to give her the standard mileage rate. And we've said that she drove
14,000 business miles, right up here, 14,000 business miles, and that it was driven evenly throughout the year. So that's 7,000 in the first half of the year and 7,000 in the second. We've applied the standard mileage rate for each half of the year, and that's giving her a deduction in the first half of the year of $35.70 and in the second half of $38.85. We add those two numbers together and we get $74.55, and we carry that over and enter it on line 1. Now, in addition, she had $500 of meal and entertainment expense, and she enters that on line 5. So her total expense in the first column, column A, is auto only, and it's $74.55. And the second expense she had is $500 of entertainment expense in column B. We then look to her company's reimbursement policy. And we told you in the wording of the problem that the employer reimbursed her $250 for the entertainment expense, so we're entering that in column B. And that the employer also reimbursed her 14 cents per mile. She submitted mileage reports for 14,000 miles. 14,000 times 14 cents per mile is 1,960. We enter that in column A. We then subtract the reimbursement from the expense to get the allowable business deduction for that category of expense. And here we have $250 of entertainment reimbursed against the $500 of expense, and the difference is $250. Now we do have to multiply column B by 50%. We have to apply the 50% limit, but you will see that it says if you are a Department of Transportation hour of service limits, multiply the amount by 80% as well. Just zoom in so you can read that. It says right here, in column A, enter the amount from line 8. In column B, multiply line 8 by 50%. But if you're affected by DOT hours of service limits, multiply the meal expense by 80% instead of 50. So it's written right on the form, lest you forget. Now, the unfortunate thing is that Schedule C does not have that same instruction the same way written on the form. So on Schedule C, you kind of have to be thinking about what you're doing. And if you're dealing with a self-employed trucker, for example, you're going to have to figure that 80% manually. It doesn't tell you to do it on the form itself, but it could in the form instructions. So the total allowable deduction that we have for our filer is $5,620. And we're going to go over to page 2 of Form 2106, where we have to provide information about the vehicle that she is driving. And this information is mandatory. The IRS does want to know the date placed in service, the total miles that the vehicle was driven, the total miles that were business miles, and the total number of commute miles, as well as the round-trip daily commute. Now, I don't know about you, but I certainly have trouble getting this information out of my clients. I cannot tell you how many times I will ask the same client for the same information year after year after year. The part where I want to know their total mileage, the part where I want to know what portion of the total miles was business, what portion of the total miles was commute, and what portion of the total miles was something other than commute or business. They will forever and repeatedly give me half of what I ask for. I'll even send an email in bullet form in writing. It'll say, "Dear client, please tell me the total miles you put on your vehicle for all purposes during the year." Number 1. Number 2, please tell me the number of miles that you drove during the year that were business miles. Number 3, please tell me your round-trip daily commute distance. And number 4, how many commute miles did you drive for the year? And they'll email me back, my business miles is 10,000 miles. So then I go, great, you've answered one of my 4 questions. Now I haven't even got to the date placed in service, which is also required information. And do you have another vehicle available for business use or personal use? Of course, those questions have to be answered as well. Was your vehicle available for personal use during off-duty hours? Do you or your spouse have another vehicle available for personal use? Do you have evidence to support your deduction? And if yes, is the evidence written? We have to answer all of these questions here. They're not optional. Question. There's a question in the classroom, why does the IRS ask for the commuting miles? Well, I've never asked the IRS why they ask for that, but I've deduced the answer, you could say. The IRS is asking, as I deduce, for the commute miles because they want to know that commute is not included in the business figure. By asking for a commute on a separate line, they're trying to ensure that you haven't considered or treated commute as business and put it in with the business. But commute is personal. So sometimes that throws my customers off. How come you're asking me for commute? I thought that wasn't deductible. Yes, it's not deductible. Just give me the number. Thank you very much. I got to put it on the form. There's a line on the form and it asks for the commute. Please tell me what that number is so I can put it on the form. Thank you. Huh? Can you calculate the number? Well, usually I do end up working with my client to actually calculate the number because they'll tell me that the commute distance is 10 miles round trip and say, all right, how many days in the week do you work? How many weeks in the month or the year did you work? It's usually 50 weeks out of 52 that they worked. There might be a few vacation days, like July 4 and so forth. But pretty much we're going to come up with a number that's close to accurate just by multiplying the round trip daily commute by the number of days they would have driven to work during the year. Now, of course, with school teachers, they usually only work half the year, right? So they have a much smaller number of work days. So they work more than half the year. But question is, can you use commute miles to figure out business miles? Well, no. Commute miles, figuring out the commute miles gives me one line to put on the form. What their business miles are is a completely other topic. And business miles have to be associated with a business purpose that is not commute. So that's a completely different topic. Yeah, no, commute miles are never used to establish any kind of a deduction at all. It's simply a recording function on the form. I have a question here. Can teachers claim miles? Well, if you're a teacher who goes on a field trip and uses your car to take students in your classroom on a field trip, that would be a deductible business use for a teacher. If you're a teacher who has to attend a monthly meeting, that would be, the cost of traveling to the meeting, yes, because it's away from your main job or work location. So teachers often have mileage expense. It's quite common for them to have it, but obviously driving to and from work for a teacher is also commute and is non-deductible. Next up, I'm going to mention statutory employees. We're really close. We're going to give you another break for the day, but I wanted to talk about statutory employees before we do that. If you have a client with a W-2 that has the statutory employee box checked, then you claim the employee business expenses on Schedule C rather than on Form 2106. Statutory employees can include individuals employed in the following professions: certain agent and commission drivers, full-time life insurance representatives, certain home workers performing work in accordance with specifications furnished by the person or organization for which the services are performed, and certain traveling or city salespersons working full-time except for sideline sales activities for one firm or person soliciting orders from customers. If you meet the definition of statutory employee, your employer must indicate this classification by checking box 13 on your Form W-2. This tells the IRS that you have the right to report the expenses on Schedule C instead of on 2106. And that's a good deal for the worker because then the expenses are not subject to the 2% limit. And on top of that, they're not having to worry about increasing their adjusted gross income. I mean, if you're an employee who, let's look at an example. You've got a shoe salesman, and he's got a W-2 showing $180,000 of income for the year, all of it pretty much coming off of commission sales work. But he's incurred $30,000 of travel expenses and entertainment expenses to generate that $180,000 of income. Well, the front page of his tax return after he claims his expenses is going to show $150,000 of adjusted gross income rather than $180,000. And that can have other benefits when we get into the deductibility of other types of items that might be subject to phase-outs of their own. So it is a good deal. So we're on to the next topic of the day, work-related education expenses. Now, of course, education expenses can be claimed in multiple ways. There is the tuition and fees deduction. There is the lifetime learning credit, and there is the American Opportunity Credit. The other method that you might be able to use to claim education is as an itemized deduction on Schedule A. And if you actually go back in time to before 1998, Schedule A was the only place you could claim education. So other options such as the tuition and fees deduction and the education credits are kind of recent historically. The idea of claiming education on Schedule A is actually an old idea. And the rules that are in play for 2011 about claiming education on Schedule A are the same as they have always been. There's been no adjustment or change to these rules. They are what they are and what they have been for the last 20 years. So if you have education expense, when are you allowed to claim it on Schedule A? We are allowed to claim it on Schedule A only if you can show it was work-related education.
To be deductible on Schedule A, the expenses must be required by your employer to keep your present salary, status, or job, or serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. Let's think of qualifying education expenses. I know this class, the one I'm teaching you, that's qualifying because it's work-related. It's actually, for most of you, you're required to have it to get your license renewed or your PTIN number renewed, right? So that's a perfect example of it serves a bona fide business purpose. And, well, it's not necessarily required by the employer. It's required by the IRS or your state, right? So similar idea. Now, even if one of these three tests above is not met, or pardon me, even if they are met, you cannot claim a deduction for your expenses if they are needed to meet the minimum educational requirements of your present trade or business, or are part of a program of study that can qualify you for a new profession. Now, one of the examples I can remember reading that IRS has provided about an example of someone who could not claim expenses because they qualified him for a new profession was an attorney who went back to school to study business law so that it would aid him in his practice as an attorney. But as a result of the education he received, he qualified to become a CPA. He could go sit the CPA exam and pass it. And so they said no. He actually went, I think he went the whole way of becoming a CPA because he felt being a CPA coupled with being an attorney would aid him in his work as an attorney representing his clients, and IRS said no. Education expenses may be claimed in more than one way, and I've already told you what those are, but you, of course, cannot claim your deductions on Schedule A and as a credit or as a tuition and fees deduction at the same time. You're going to have to choose. Now, there is special rules regarding education expenses for teachers. If you are a teacher, the following rules apply. Once you are considered a teacher under the rules for your state, additional education required by the state to keep your job shall be considered qualifying education for purposes of the deduction. And once you have met the minimum educational requirements for your state, you are considered to have met the minimum educational requirements for all other states that you later go to work in. All teaching and related duties are considered the same general kind of work. A change in duties in any of the following ways is not considered to be a change to a new business. So the attorney who adds CPA to his credentials to further his work as an attorney in the business world is a no. But an elementary school teacher going to a secondary school teacher was allowed. Teacher of one subject to another subject is allowed. Guidance teacher or classroom teacher to guidance counselor is allowed, and classroom teacher to school administrator is allowed. So I think that there's a big difference between being a school teacher in a classroom, personally, and administering a school. I think those are completely different things, frankly. But IRS says no, that's okay. Now, claiming educator expenses. If your educator expenses, when combined with your allowable miscellaneous itemized deductions, total less than 2% of your AGI, you should claim your educator expenses up to $250 as an adjustment to income on Form 1040, line 23, or on 1040A, line 16. But if your educator expenses are more, you can claim that $250, subtract the $250 from your total education or educator expenses, and then claim the difference on Schedule A or 2106 if it's required. So speaking of educational expenses, which are deductible, you are allowed to claim the cost of tuition, books, supplies, lab fees, and similar items. Also, certain transportation and travel costs, driving to and from school. Can I claim the cost if I get off work at the end of the day and I go to the night class for 3 months? Can I claim that cost? The answer is yes. If the education meets the requirement of being deductible, then the transportation to that education is also deductible. Other educational expenses such as research costs, typing costs, etc. And I already mentioned transportation. If you are going to school on a temporary basis, that is 1 year or less, you can deduct the cost of traveling from work to school and from school to home. If you are going to school for more than a year, you can deduct the cost of going directly from work to school only. And it's just basically looking at school in this situation as being kind of like a secondary job location. Your job is to be at school for your job. You should claim your unreimbursed educational expenses on Form 2106. However, you do not need to file Form 2106 if you are not already claiming travel, entertainment, meals, or auto expense. So if the only expense you have is education, and you don't have auto or any of the other forms or other types of costs that require Form 2106, you don't need to attach the form. And here's an illustration of what I mean. You paid $6,000 for tuition and other college fees related to your current occupation. You are not claiming any auto expenses, and your employer did not reimburse any of your expenses. You are not required to file Form 2106 and can report the expenses directly on Schedule A. Alicia Montague asks, is internet service an education expense if the class is online? Well, I look at internet as something that needs to be prorated. If you're paying a monthly subscription for internet, how much of the percentage of the use of that internet is business, education or otherwise? And I would claim the percentage of business use. Internet is something I frequently claim as a business expense for my clients, but it's also something that would obviously have personal use applied to it as well. So if you're paying for home internet and that internet is supplying your computer and you use your computer for personal and for business, what percentage of the time is it going to be business? And that would be how the percentage I claim on the internet.